All right, we are back. In the last video segment, we spent a little bit of time discussing the relationship between the money supply and prices in the long run, specifically how growing the money supply is related directly to the rate of inflation, and that relationship is almost a one-for-one relationship. It's a very close relationship based on long-run data. It is a long-run model. We so far have abstracted away from details regarding how the central bank controls the money supply, and I wanted to spend a little bit of time in the next series of videos going through some of the minutiae involved in the fractional reserve banking system. So just to recall a little bit of what we'd done last time, we talked about monetary policies being conducted by the central bank of a country or of a group of countries. And in the United States, the Federal Reserve is the central bank tasked with this objective. The Federal Reserve consists of a board of governors and some regional banks, and the Federal Open Market Committee is made up of a rotating subset of the board of governors and the presidents of these regional banks. Jerome Powell is the current Federal Reserve chairman, maybe soon to be replaced by the president. So we'll see how that goes. And we also discussed a brief history of the Fed chairmanship and discussed a little bit of background regarding this handsomely diverse group of youngsters. I want to start off today by looking at a term known as the monetary base, and this is going to be the foundation of how we think about the Fed really controlling the money supply. So the story is a little bit more complicated. The Fed doesn't have godlike control over the money supply, but it does control what is known as the monetary base. So we're going to think about this question in the next set of slides, or rather in the next set of videos here. And I'm going to use M to denote the money supply, and I'm going to use our definition predicated on M1, just the sum of currency in circulation and checkable deposits. So the money supply M is the sum of C and D. And the Federal Reserve is involved in issuing currency. Hey, however, banks and their customers are the ones that decide on how much of that currency they're going to put away in checkable deposits. What the Fed really does is it doesn't create the money supply per se, but it does control what is known as the monetary base. So I really want to start not with our definition of M today, but I want to start thinking about the definition of the base, which we're going to call B. And the monetary base, not to be confused with the money supply, they are different, aside from one particular situation, which we'll talk about in a moment. But the monetary base is the sum of currency in circulation and bank reserves. So B equals C plus R. Again, currency in circulation is held by people and firms outside of banks. R, the reserves, these are held in banks in their cash vaults and in ATMs, as well as deposits with the Federal Reserve. The way that we're going to think about the Fed as generating the base or creating the base is through its toolkit. And one of the most important tools in the Fed's toolkit is what is known as open market operations, which is a very fancy term to describe the buying and selling of government bonds. So the Federal Reserve, it does trade treasury bonds and bonds of various government-sponsored entities. During the crisis, the Fed also engaged in some somewhat atypical asset acquisitions in really an attempt to get a hold of the rates in the housing market. And we're going to define here an expansionary open market operation as an open market operation that is going to increase the amount of money in circulation. And this happens when the Federal Reserve buys bonds. When they buy the bonds, what does that look like? Well, when the Fed buys bonds from somebody, what does the Fed do? Well, it gives that person money for the bonds. And that is going to increase potentially the amount of currency in the base. A contractionary open market operation, on the other hand, is when the Fed sells bonds. And when they sell bonds, they are taking money out of circulation, and that'll have the effect of reducing the base. So to summarize here, expansionary open market operation, we are buying bonds. A contractionary open market operation, we are selling bonds. Buying bonds puts more money into circulation. Selling bonds takes money out of circulation. Hence the expansionary and contractionary. So, for example, let's suppose the Fed buys $100 of bonds from a bond dealer. If the Fed pays that dealer cash, currency goes up by $100. And if the Fed deposits $100 in the dealer's bank account, then deposits increase by $100 and bank reserves also increase by $100. In either case, either transaction increases that monetary base by exactly $100, whether or not it's going into currency in circulation or reserves in the bank vault. So to conclude here, the $100 purchase or the expansionary purchase of bonds by the central bank has caused a $100 increase in the base. Now, this process works in reverse for a sale of a bond. When the Fed sells a bond to a dealer, okay, let's suppose for $100, okay, then that money is essentially pulled out of circulation. It comes out of currency or out of the reserves of the bank vaults, and this reduces the base by exactly $100. Okay, the other way that the Fed can effectively control the base is by making loans. Okay, and buying and selling bonds is a type of way of formulating a loan contract with another entity. But if we were thinking about specifically what is known as a discount loan, for example, is a loan that the Federal Reserve typically makes to a FDIC member bank. And this is typically done as what is known as the discount rate, which is the interest rate that the Fed, who is the lender of last resort, charges to the member banks. And in the past, the Fed has used various types of mechanisms to allocate these loans to member banks, things taking the form of, for example, auctions where banks are bidding on rates. And discount lending is most prominent during financial crises when the Fed engages in emergency loans and acts as the lender of last resort. So I want to be clear here, the discount loan, that is different than the federal funds rate. Okay, there is an interest rate that the Federal Reserve targets using the open market operations. That is the interest rate at which member banks can loan to one another in the event that their reserves are short. Okay, the discount loan, or the discount rate rather, is the interest rate not from member banks lending to each other horizontally, but from the Fed loaning downstream vertically. Okay, so if the Fed makes a loan to a member bank, we call that a discount loan at the discount rate. But if member banks loan to each other, okay, then we refer to that as the federal funds rate would be the relevant interest rate that is being targeted on those particular loans between the member banks. So if the Fed wanted to increase the amount of money in circulation, an alternative way of doing this is to make a loan. Okay, if the Fed makes a loan to a bank, this raises the bank reserves by exactly $100, increasing the base by $100. Conversely, repayment of that loan pulls that money out of circulation, reducing the base. Okay, so in a minute, we're going to take a look at an example involving the Fed's balance sheet. Okay. And we're going to go through a numerical example to really look at in a fair amount of detail what we mean by the money creation process. Okay. We're going to see here as a consequence that the Fed, while it does control the base, the public's decision to switch between deposits and the bank's decisions to hoard reserves can potentially work in the opposite direction where the Fed is trying to control the base. When this happens, the Fed loses its control over the money supply. And we will take a look at that in the next set of videos. So stay tuned for more.